Everyone can see that. My name is Ron Ricard. I work for a company called Investment Property Exchange, or IPX 1031. We are what is known as a qualified intermediary. Our job is to help you do 1031 exchanges. If you are so inclined and want to scan that QR code, that will download my information onto your phone, and so you're more than welcome to call or email or text me with additional questions after tonight. I've been doing this, like Donna Marie says, not quite 100 years, but 24 at least. And so I'm always available to answer questions as they come up. Tonight we're going to be talking about exchanges, basically anything having to do with real estate and taxes. So let's start at the beginning. What is a 1031 exchange? 1031 refers to a section of the tax code. It's a section of the tax code that says, in essence, when you own real property that you use for business or investment purposes, you can sell that property by like-kind property, which I will define in a minute. And as long as you follow the rules, you get to defer paying taxes on the profit that you've made. So what does that mean in English? You have a rental house. You've been renting it for the last 30 years, just like Donna Marie's latest client. They want to sell that and buy a fourplex. So you call Donna Marie. She lists the property for you. You go through the regular sales process. At the close of escrow, the money comes to a third party called the intermediary. That's what we are. Our job is to hold your money between what you sell and what you buy, and we are a required part of any 1031 exchange. Essentially, what's going to happen then is once escrow closes, the funds come to us. Then you find that fourplex you want to go buy. We send the money to the title company on that side, and the property closes. In the eyes of the IRS, you sold a piece of investment real estate. You bought a piece of investment real estate. And because you never touched the money, because we had it, you get to defer paying taxes on the profit that you've made. Now, most of you are thinking to yourself, oh, this is just for rental property. I'm going to push back on that and say with enough planning, taxes can be deferred or even eliminated on almost any real estate sale. We just need a plan. We just need to execute that plan, and we can almost always save the taxes. So we will talk about that on all different kinds of property here over the next half hour or so. Now, first thing I want you to remember is that I said 1031 exchanges defer the taxes. It does not eliminate the taxes. So let's say you do an exchange for that rental house to a fourplex. Later, you exchange that fourplex for an eightplex. Now you're tired of real estate and you just sell that eightplex. When you sell that property, you pay taxes from the first property, the second property, and the third property. It is cumulative. So you are just deferring the taxes. Now, sometimes people will ask me, well, why bother doing an exchange if I'm going to have to pay the tax man anyway? Well, there are two reasons you always want to do an exchange. Number one, do you want to pay your taxes today or tomorrow? I think for most of us, the answer is going to be tomorrow. The way I look at it is this. If you make $600,000 of profit on a property, you're going to pay about $300,000 or $200,000 of that in taxes to the government. What would you rather do? Give $200,000 to the government or take that $200,000 and use it yourself to buy more real estate? For most of us, it's the latter. But the real reason we want people to do exchanges is because most of us will never have to pay the taxes. Because sadly, one day we're all going to die. And when you die, you win. Well, be honest, when you die, your kids win. Because when you die, your heirs get what's called a step up in basis. I want to make sure we understand this. I bought a property many years ago for $100,000. Today it's worth $1 million. If I sell it, I have a $900,000 gain to pay tax on. But the day I die, whoever inherits the property from me, their basis is the value of the property at my time of death. And if your kids are like mine, the day after my funeral, they're selling all my real estate. And when they sell it for $1 million, how much capital gains do they have to pay? Zero. It's worth $1 million when I die. That becomes their basis on the property. Now, if they hold on to it for a while, it goes up in value. Now there's a gain. But the day they inherit the property, that establishes their basis on the property. All the taxes that you would have paid, all the gain that you had while you were alive, all disappears, poof, when you die. That's the real beauty of the 1031. That's why the motto of our industry is swap till you drop, because the idea here is that you never, ideally, you never have to pay the taxes. Now, one thing I want to make clear here, this step up in basis only happens when you inherit property. It does not work when you gift property. So the idea of giving property to your kids or adding them to title on your property is usually a bad idea, because it will not allow them to get that step up in basis. It's much better in almost any circumstance. It's almost always better to inherit property than it is to have it gifted to you while you're still alive. But enough about dying. There's a term I use in the beginning that is very confusing, though it's very commonly used in these. They're referred to as like kind. What is like kind? Like kind means any kind of investment real estate for any other kind of investment real estate. So you can sell a rental house and buy a commercial office building. You can sell a farm and buy an apartment building. You can even sell bare land and buy income producing property. It's much, much more flexible than most people think. Also, 1031 is good anywhere in the United States because it's federal law. So you can sell in California, buy in Florida, buy in Hawaii, buy in Tennessee, and you're still deferring both state and federal taxes. So it's good anywhere in the country, between any states, and it's any kind of investment real estate. The term like kind harkens back to many years ago when we used to do exchanges on things other than real estate. In my career, I've done exchanges on airplanes, I've done exchanges on boats, I've done exchanges on farm equipment. I've done exchanges. I did an exchange once for a gentleman who sold a FedEx delivery route and bought a UPS delivery route. That was a like kind exchange. So when you sold a boat, you had to buy a boat. When you sold farm equipment, you had to buy farm equipment. What happened was in 2017, Congress completely eliminated all 1031 exchanges except for real estate. So we no longer have these personal property exchanges. Now 1031 is only about real estate. So that term like kind is a little misleading. Any kind of investment real estate for any other kind, anywhere in the country. Now, I did say it has to be investment real estate. So what kind of real estate do we think of as not being investment real estate? Your primary residence. Your primary residence is under a different section of the tax code. It's under section 121 of the tax code. Now, section 121 says when you sell a primary residence, you get to keep the first $250,000 of gain if you're single and $500,000 of gain if you're married. Now, some of you may remember the old rule when it came to primary residences. If you sold your house, you needed to go buy another house. And as long as you kept buying another house, then you kept deferring your taxes. I know when Donna Marie started becoming a realtor, that's exactly how the law was. But nowadays, it doesn't matter anymore. Nowadays, when you sell your primary residence, it does not matter if you buy another house or not at all. If your gain is in excess of that exemption, you pay tax on that excess amount. Now, that $500,000 was a lot of money back when the law passed back in 1997, almost 30 years ago. But that's not the case anymore. Nowadays, $500,000, especially here on the peninsula, is not a lot of gain if you own your property any length of time. So, if you don't want to pay taxes, is there anything else that you can do if you don't want to pay? If you don't want to pay the tax man on that excess gain? There are a couple things you can do. First off, does any portion of your property qualify? Do you have a home office? Do you have an ADU? Do you rent out the basement? Do you run your business from the property? Is there any part of the property that you are declaring to the IRS? That's very important, that you are declaring to the IRS on your taxes as being as being business or investment real estate. Because if you are, whatever that percentage is, that percentage of the sales price you can do an exchange on. And I'm seeing this more and more because places like San Mateo County have really been pushing people to add ADUs on their property. That's wonderful. If you're renting it out and declaring that rent on your taxes, you might be showing 10, 15, 20% or more of your property as rental. I did an exchange late last year for a couple. They had a property in Woodside. Over the years, they had built 3 ADUs on that property. And according to their accountant, 51%, more than half of their property, was considered to be rental property. And so when they sold that property, 51% of the sales price went into the 1031, and the other 49% they kept as a primary residence and got their $500,000 exclusion against. So the key here is, if you have a property that you are already declaring as investment, that you're already showing partially as business or investment real estate, whatever that percentage is, you could do an exchange on that percentage of the sales price. Now, the truth is, we love this idea, but most of us still don't have ADUs. Most of us still don't have home offices that we declare on our tax return. So what are we going to do if we don't want to pay tax on that excess gain? Move out. Turn your house into a rental property. Now, after you've been renting out the house for a couple of years, is that house now an investment? The answer is yes. Is it still a primary residence? The answer is actually yes. Under Section 121 of the tax code, you needed to have lived in the property 2 of the last 5 years. And if you meet that criteria of having lived in the property 2 of the last 5 years, then you get to take advantage of both tax rules at the same time. So you could do an exchange and still pocket the $250, or if you're married, $500,000 exclusion. Now, a couple words about this. First off, this obviously does not work for everybody. If you need the money from your house to go buy a bigger house, it's not going to work for you. But if you have the ability to go buy another property, or maybe you already own something, or maybe you're moving to a retirement community or as assisted living or somewhere where you can afford to move somewhere else and keep your property as a rental, this would work. Also, note that you are reinvesting the entire sales price of the property minus the exemption. So if your property, in fact, just this morning, I set up an exchange for a couple, sold their house, I believe it was in Atherton, for $8.6 million. Well, of that 8.6, they get to keep 500, but they need to do an exchange on the remaining $8.1 million. I don't care what they bought the property for or what their loan was. We'll talk about that a little bit later, but it's equal or greater to the sales price minus the exemption. So the key here is, though, that if you have a highly appreciated primary residence with hundreds of thousands, or in these days, some people have millions of dollars of actual taxable gain or actual taxes they would pay by selling their primary residence, this is a strategy we are seeing very frequently. I probably set up 2 or 3 of these every single week for people who've owned their property, moved out of it. Now, one question always comes up here is, how long do you have to rent it for in order to qualify? The tax code does not actually answer that question directly. What the tax code says is you need to convert the property into being an investment. Now, many years ago, when the IRS showed us how to do this, they used an example of 2 years, but very importantly, they did not say it had to be 2 years. So talk to your accountant. Most accountants would recommend 1 to 2 years of rental history on the property in order for it to qualify. I will also turn this around. This does not work the other way around. If you have a rental property and move into the property, the day you move in, it stops being an investment property. So this whole thing of having lived in the property 2 of the last 5 years only works if you have lived in the property and then converted it into a rental. So this is a strategy that, again, we are seeing a lot of, and this is exactly what Donna Marie was talking about up front, where this is something that she was able to help a client with and save $1 million in taxes. So what other properties don't qualify for 1031? Well, first off, flips. You buy a beat up old house, you fix it up and you sell it. The IRS calls that a job. They don't call it investment. Same thing with development. You buy a beat up old house, you fix it up and you sell it. You buy a beat up old house, you bulldoze it, you build a new one and you sell it. That is considered to be, again, a job, not investment. both flips and developments, I do the analogy of going to the grocery store. When you go to the grocery store to buy a can of soup, that soup is not investment for Safeway, right? It's inventory. They bought it because they want to sell it to you at a higher price. They buy a chicken, they cut the head off, they wrap it in plastic, and they sell it to you. That's a fixer upper. They bought it, they fixed it, they sold it. That's what you're doing with real estate. So neither of these are considered to be property held for investment purposes. They're considered to be property held for resale. Also, you cannot exchange into any kind of non-direct ownership of real estate. So you cannot exchange it to any kind of partnership or syndication or REIT because that is not direct ownership of real estate. In a 1031, you have to sell real estate and buy real estate. You have to have direct ownership. Also, second homes do not qualify. Now, most of you are thinking to yourself, second homes, that little place in Santa Cruz or Lake Tahoe or maybe Hawaii that you like to go to, and it's for your own personal use. I will also say this includes any family use. So if you own a property that you are letting a family member live in rent free or for very little rent,
No.
that is not considered to be investment real estate. It's considered to be a property for the personal use of the family. The IRS views it as a second home, does not qualify. So, side note for you, for those of you who have a property and they're letting their kids or their parents or somebody live in that house rent free or for very little rent, that does not qualify. Family members must pay market rate rent in order for the property to qualify as investment real estate. Now, now we talk about second homes. Well, what about vacation rentals? Yes, a vacation rental does qualify for 1031. And going back to what I said at the beginning, with enough planning, we can almost always avoid paying the taxes. So let me give you the story of a couple I know. They live in the Los Altos Hills, have a beautiful house, and they also had a second home on the beach in Aptos, and they used to go there all the time. But then the kids did that silly thing kids do and grew up, and they went to college, and they just didn't go to that beach house anymore. In fact, when I saw them, the woman told me, she goes, "I don't think I've been there twice in the last 3 years." I go, "Great, let's convert your property into becoming a vacation rental." So that's what they did. And so the IRS definition of vacation rental is a property that you rent out at least 14 days per year, not to family, a property that you and your family do not use more than 2 weeks per year.
We have something wrong in
And
the morning.
here they specifically talk about owning the property
Yeah, but
for 2 years. So the for this has to be done for 2 years. So I refer to it as the 222 rule. For 2 years of ownership, you must for the 2 years of ownership, you must rent it out at least 2 weeks and don't use it for more than 2 weeks. And after 2 years, you could do whatever you want. Here, the 2 year rule is what they establish as a what they call safe harbor, which means you have to follow that rule. So that's exactly what they did. They rented it 2 weeks that year, 2 weeks the next year. They did a 1031 exchange to a house in Park City, Utah, with the anticipation of doing the exact same thing, renting it for 2 weeks 1 year, 2 weeks the next year, and after that, they were going to convert their house into being back to being a second home because now the kids like skiing more than they like to go to the beach. So again, this is a great strategy is to have your property as a vacation rental for it to qualify. I think we've talked about pretty much all the kinds of real estate that are around. So the next question is what let's talk about the mechanics of the 1031 itself. The first thing to realize is there's a very strict limit when it comes to time limit, when it comes to exchanges. From the day escrow closes, you need to know what you're going to buy within the first 45 days. So you have 45 days to identify what you're going to buy, though you have 180 days to actually buy it. Now, what does identify mean? Identify means you give us a list of up to 3 properties. There are ways to identify more than 3, but I'm not going to get into that. But you give us a list of up to 3 properties, but that must be the exact address. 123 Chapin Way in Burlingame, 456 El Camino Real, unit number 2. It's the exact property. It's not a house in Hillsborough. Okay. It's the exact property you're going to purchase. And you can give us that list of three. Now, the next question is, do you have to be in contract by the 45 days? Technically, no. Technically, you gave us this list of three properties. But if on day 46, all three of those properties are sold to somebody else, you're out of luck. So here's my suggestion. By day 45, you're in contract. If you're getting a loan, you get the loan approved, you get the inspections done. You want to be locked into a property by the time you get to the 45 days. So 45 days to tell us what you're going to buy, 180 days to close it. Also, remember that clock starts at the close of escrow. So, to the degree that you're selling a property and you want more time, the easiest way to get more time is to get Donna Marie to find the buyers to get you a longer escrow. That gives you that much more time before the property closes. Next thing to know is how much do you need to spend in a 1031 exchange? And the answer is very simple, all of it. Not the profit, not the equity, everything. Equal or greater to the purchase price. Now, we show on here net sales price because you can subtract your realtor and escrow fees. So if Donna sells a property for you for $2 million and there's $100,000 worth of escrow and realtor fees, the net sales price is 1.9. You need to buy at least 1.9 worth of replacement property to defer all your taxes. Part two, equally important, all the equity, all the cash that comes from the sale, all has to go to the next property. Any cash that's left over, you pay tax on. So equal or greater, use all the cash. Now, if you do have a loan on that property, the title company will pay off that loan when escrow closes, but you need to make up that loan when you buy the next property, either with another loan or with cash from your pocket. So if you sold a property for $2 million and you had a $500,000 loan, the 1.5 of equity has to go as a down payment, but that other $500,000, you still need to make it up. So either you need to get another loan to make it up, or if you have cash yourself, you can use that as well. There's a common misconception that you have to get a loan, and that's not true. You can replace the loan with your own cash. So equal or greater, use all the cash. As long as you're doing that, then you're deferring paying your taxes. So in a nutshell, that is what a 1031 exchange is. You're selling investment real estate, you're buying investment real estate. You're needing to know what you're going to buy within that 45-day window, and you need to spend all the money on the next property. As long as you're doing that, you're deferring all your taxes. Now, why do people do 1031 exchanges? And most of you are thinking to yourself, well, you do it because you don't want to pay taxes. And I push back a little bit on that. The easiest way to defer your taxes is don't sell it. The reason you do an exchange is because you want to buy something better. Now, what does better mean? Better means whatever you want it to mean. Maybe better means I want to take this real estate and build my real estate empire and just use it and leverage for more property. Maybe you're looking for something with better cash flow. Maybe you're looking for something easier to manage. Maybe you're looking for something that you later on in future may move into. Maybe you want to buy a house in an area where your grandkids or your daughter can rent from you so your grandkids can go to better schools. Maybe you're moving to Arizona, so you want to move your rentals to Arizona. Maybe you want to sell three properties to buy one big one, or the other way around. Sell one big one to buy three small ones. I do exchanges for people who use the 1031 as an estate planning tool. They don't want their kids to fight over the real estate, so they do exchanges so that each kid knows exactly what they're going to inherit, and there's no fighting because it's already pointed out in the trust how they're going to inherit it. So the reason I point this out to you is, again, we don't think of 1031 exchanges just to defer taxes. The key is you're reinvesting that money into something better for you. And that better is subjective, but it's what you want out of your real estate, whether it's cash flow, location, management issues, whatever the case might be. That's why we look at doing a 1031 exchange. Now, many of you are going to be thinking about that time of your life where you're retired or close to retirement, and now you're looking for something different. Now you're looking for what we call an exit strategy. My father, when he retired, he goes, "I'm done with real estate and sold everything." Well, I'll get to him in just a minute. The key here is when you get to the point where you're just tired of owning real estate, there are strategies that you can use. Obviously, you can always pay the taxes. I never recommend that. Dying, as I mentioned, is a great tax strategy, but again, I don't recommend that. Seller financing, I think, is a great tool. This is actually what my father did when he cashed out his real estate when he retired. He carried a note, and what that note did is two things. One is it stretched out his tax bill over 20 years. As he got paid over 20 years, it stretched out his tax bill over 20 years under what's called the installment sale provisions. And more importantly, it gave him cash flow. So as a retiree, he was able to receive payments every month, and that cash flow, was nice when you're retired. So seller financing, I think, is a great tool if you are cashing out. By side note, if you are wanting to do an exchange, seller financing does not work very well. But it is something that we do see. We do see this a lot, especially in rural and commercial settings. Um, and something I mentioned earlier, do a 1031 exchange into a property that you are later going to convert to the house you want to retire to. I see people doing this all the time. They want to do a 1031 exchange into a retirement community or to a house in Hawaii or a place where maybe their kids live now, with the expectation is in a few years, after renting out the property for a few years, now I'm going to retire. I'm going to retire to Hawaii. I'm going to retire next to the grandkids or somewhere where you can basically move into the property. One thing that's important to note here is that when you do this, you do need to rent the property for a few years before you move in, but also there is no tax due when you move into the property. So converting the property does not create a tax liability. Now, if and when you ever sell the property, there may be a tax liability, but just the converting that's itself into your rent, into your living place, does not create any kind of tax liability. As I mentioned earlier, doing some estate planning so that each kid knows exactly what they're going to inherit. One of my favorite stories about this, I did an exchange once for a woman who had three kids, and these kids were fighting like crazy. So she goes, "The heck with it." She sold her property, bought three properties, virtually next door to each of her three kids, and she goes, "I'm going to have them manage it and send me the money, and then they can figure out once I die whether they want to keep it or rent or sell it themselves." But she was having each of their kid do her property manager be the property manager for her. So I love that idea. What a lot of people do also is that they will exchange into low maintenance assets. Now, one of these is referred to as net lease or sometimes called triple net commercial real estate. That's where you're buying a McDonald's. That's where you're buying a Jiffy Lube or a Walgreens. Now, you aren't owning the business, but you are owning the real estate and leasing it to major corporations around that could be anywhere in the world. But the idea here is that it's referred to as triple net because the tenant pays the property taxes, insurance, and the maintenance, and does all the maintenance. So it's very low maintenance on your behalf. Typically, these have very long-term leases. I've seen leases as high as 50 years, and very little management on your part. So very predictable cash flow, very little management. So that's one option. The other option, though, is to buy something that's a little more bite size. The problem with triple net or net lease properties is that anything decent is going to be $2, $3, $4 million or more, whereas you can buy a fraction of commercial real estate also. It's called a TIC, but most of them nowadays are structured under what's called a Delaware Statutory Trust or DST. What a DST is fractional interest in commercial real estate. So what you have there is a company who will go and find a 50 or $100 million mega apartment building or a big commercial building or an apartment building or a government building. And they will bring it to the market and say, okay, you can buy it. You can buy as little as $100,000 worth of a $100 million property. And because you have direct ownership of that percentage of the property, it does qualify for 1031. The advantages are it is very predictable cash flow in very high quality assets. and very little management. Now, it's not perfect. The biggest negative to it is not liquid. So, you cannot sell it whenever you want. I mean, technically you can, but you're not going to get what it's worth. So, when you're in these properties, you're going to be in them for the 4 to 6 years until the manager decides it's time to sell it and move on to something else. So again, that lack of liquidity is an issue for some people, but if you don't care about that, you just want to get into something that is easy management and cash flows positive, then that is something worth considering. But one side note for us is, as far as the 1031 is concerned, whether you buy a house in San Mateo or a DST, it is just a replacement property in a 1031 exchange. It's not any kind of special kind of an exchange because you're buying these, as sometimes people have alluded to. And with that, that is what I have to talk about today. And I kept it to about the half hour that Donna Marie likes me to be talking for. And what I will do now is stop the share and and answer any questions people have. Before I go there, a couple of things I do want to point out. Again, my job is to answer questions about exchanges and how I can best help you. So if you have any questions after today, you want to reach back out to me, feel free to call or email, text. I'm here to answer questions. Even if you're just planning the exchange, I'm here for you. So with that, with a small enough group, I think we can just unmute yourself and ask a question as it comes up. Or Donna Marie, did you want to say anything first?
I wanted to know, on the Delaware Statutory Trust, is there a stepped up basis so that the heirs don't pay capital gain?
Yes, like all of your assets, primary residence, investment real estate. A DSC is just investment real estate, so you do get a step up in basis there. Now it's kind of a little bit tricky in the sense that in terms of establishing what the market value is of the property, depending on when when the person passes away compared to where they are in the life cycle of the property. But yes, you still do get you still do get the stepped up basis.
And when you're doing your 1031 exchange, and I'll just make up numbers, $3 million, and then you take and this is after you've converted your single family home to a rental property, which is 2 years. You take the cost of sale, moi. Can you also take the cost of staging and painting and the cost of the inspections and repairs, so that 300,000 after the section 121 is taken away, and I'm going to use 500, and then take away the cost of sale, and I'll make it let's see, 2.5 down to 2.3. Can you then take the cost of preparation for the sale and do?
No,
Oh, really?
no. The only thing that you could factor in are the non-recurring closing costs, escrow, title, which in San Mateo County is nothing for the seller, and realtor fees.
What?
Anything that you've done on the property, whether it was 20 years ago or 20 minutes before escrow closes, is not considered. Is not considered. It goes to your basis and is and just it goes into the next property. Now, in some cases, some of the work that you do may be an expense item, like staging. So you may get a tax deduction for staging. So that tax deduction might offset some of the expenses. But the reality is that if you want to pay yourself back any money that you've invested in that property, fixing it up, getting ready for market, etc., from an exchange point of view, those dollars are boot.
Oh, that's okay. That's interesting. And I promise this is my last question. And also, everyone, tax information has to come from your licensed tax advisor.
Please.
So, on seller financing, when they are given the down payment, I'm assuming that is taxed as capital gain versus ordinary income. And I think capital gain is lower. Is that correct?
Capital gains is taxed lower than ordinary income, yes, on the federal level. At the state level, all states tax a capital gain is the same as ordinary income tax. Only on the federal level is it lower. When you do seller financing, so if you forgetting the 1031, you're just doing seller financing note, essentially the down payment that you're going to receive, Some of that is going to be what's called return of basis, and some of it is going to be capital gain. So a share of the down payment you'll pay capital gain on, and then every year as you get the payments that you receive, some of the payments that you receive are return of principal. Some of it are considered to be from the profit and taxable. So each payment, some of it will be, a part of it will be taxable, and the interest will definitely be taxable as ordinary income.
Oh, I didn't think of that. Amazing. Okay, so I'm done with my questions. I'm
Does
looking at,
anybody else have any questions? See, Donna Marie, got everything answered the first time here this time.
yeah. Well, I'm going to let you go have dinner, but everyone, this has been recorded, and I'm embarrassed to confess I learned some things tonight, even though I've done this 50 years and you're just a newbie at 24. I did learn some things, and I thank you for that. I didn't think about the basis, and then the ordinary income
Okay.
on interest, and then the capital gain on the prop. That's exciting. So I just love anything that helps to save with taxes and understand them. So thank you so very, very much. And everyone, reach out to Ron because he'll take good care of you. And when you want to make your home even more beautiful and more expensive when you go to sell it, and this would be added onto your basis, would be Penny Chin. Give her a call. Elements in Design, Penny Chin at Elements in Design. Marty, do you have any questions?
Okay. All right. Well, thank you very much, Donna Marie. And if anybody wants to hear this again, Donna Marie's website will have this on recording.
And
Thank
I
you.
hope Ron will do it again for me in 6 months or 7
Yeah.
months.
So I usually do.
I know, and thank you so much.
All right. Bye bye.
Good night, everyone.
Good night. Thank you.
Thank you.
Thank you.
Thank you.